market news now. The U.S. economy likely maintained a strong pace of growth in the fourth quarter as consumers boosted spending on goods, but momentum appears to have slowed considerably towards the end of the year, with higher interest rates eroding demand. According to a Reuters survey of economists, GDP growth likely increased to a 2.6% annualized rate last quarter after accelerating at a 3.2% pace in the third quarter. Estimates range from a 1.1% rate to a 3.7% pace. We'll get those US GDP figures out at 3:30 South African time. Locally, fashion retailer Truworths International reported a jump in group retail sales despite record levels of load shedding affecting trading, as all the group's South African stores can operate when the power goes off. And ABSA will list its ordinary shares on ATX markets, though it will retain its primary listing on the Johannesburg Stock Exchange. The shares of South Africa's fourth biggest bank by market value will become available for trade on the alternate exchange as of February 2nd. To talk to us a little bit more about the market dynamics, we are joined by Han Tan, who is from Xfinity. Han, thank you so much for your time. Your sense of global market sentiment, especially now ahead of those US GDP figures.
Yeah, I think, to be clear, there's more sensitivity towards some of these big earnings that we're seeing out of Wall Street. But if you take a step back and look at it from a bird's eye view, there is this wait and see approach, given that we have a very important Fed decision due next week. So with just days away, we're not seeing not too many major moves. You look at the dollar, it's not falling as sharply. You look at the S&P 500, it's just kind of treading water above the 4,000 mark. So there's this wait and see approach right now.
How are you interpreting this tussle between what the Fed says it will do and what the markets expect the Fed to do, especially as we try to ascertain where interest rates are going to go for 2023?
Yeah, and that's a great question. It's something that our clients have been speaking to us about. So to encapsulate it in a nutshell, there's on one hand what the Fed says it wants to do, and then there's the market's skepticism. So that's the dynamics at play. So even though Fed officials, have come out in recent weeks before the blackout period to say that they intend to send interest rates past the 5% mark, which is what markets are forecasting right now for the peak, but markets are willing to challenge that notion. So, I think that's why risk assets from gold to even crypto or even gold prices have been willing to punch higher based on the idea that the Fed may not be able to actually hike as much as they say they would, and could actually maybe even cut interest rates later this year.
In terms of US GDP expectations, as I mentioned to the viewer, we'll be able to get that figure at 3:30 South African time. What are you going to be looking out for?
Yeah, so you're right to point out there is that expected slowdown from above 3% in Q3, with the estimate now down to 2.6% for Q4, right? And that's a quarter-on-quarter basis. So, and you're right to point out that the Fed wants to see more of that economic slowdown, or that we say economic damage in the economy. But specifically, they'll be looking to the jobs market and the inflation data. So those two data points would carry much more weight in terms of market movements compared to the GDP figures due out in a couple of hours.
One of the other phrases or statements moving around is the idea of a soft landing. And I'm wondering is that something we could possibly see in 2023, or do we throw that out the window?
Yeah, I mean, look, it's still early days, right? We're not done with not even a full month yet in 2023. As things stand right now, those chances still appear slim, because keep in mind that even though inflation has dropped considerably, it is still about 3 times higher compared to what the Fed's 2% target is, right? So I think if the Fed still intends on sending US interest rates much higher than we expect right now, that would incur more economic damage, and then there goes that soft landing that some segments of the markets hope for.
So the other news, I mean, we've been talking about it probably, in the newsroom, but not necessarily on air. It has to be the Bank of Japan and its yield curve control program. Where do you see that going out? I suppose panning out for 2023. I mean, 6 days ago, we had the governor defending it, and they still kept their ultra dovish policy.
Yeah, I think, with every passing meeting, it brings us one step closer to the Bank of Japan actually making that policy pivot. So keep in mind, its other G10 peers have already been aggressively hiking their respective interest rates and tightening policies. But you've got the Bank of Japan that's essentially still standing pat. Although, to be fair, they did deliver this massive shocker last month in tweaking some of its policy settings, right? So that signals that eventually, and perhaps sooner rather than later, the Bank of Japan is willing to jump on that bandwagon and hike their rates as well. So I think we're penciling in April because that's when the new Bank of Japan governor is set to take helm of the central bank.
If that does happen, what does that mean for the yen?
Yeah, so even in our 2023 outlook that we issued weeks ago, we had cited 125 for dollar yen as an area of interest. We had highlighted that the yen is expected to be one of the best performers in the G10 currency space for this year, and so far that has been on track. But again, a lot of that is based on whether the incoming governor actually takes a different approach to inflation. It is already at a 40-year high, but the current governor still thinks that it's not sticky enough. So if that perspective is changed with the new governor, then we could see a resumption of a path towards 125 for dollar yen.
Before I let you go, your conviction on emerging markets for this year?
Yeah, so I think for right now, at least in terms of a currency perspective, obviously they're taking delight in the weaker US dollar environment, given the kind of pain that emerging markets have seen all of last year. But having said that, the second half of this year could prove tricky as well, because by then, number one, we'll know about the odds of a US recession, and obviously that will have repercussions around the world, including emerging markets. And secondly, by the second half of this year, we'll know whether the optimism surrounding China, its reopening, whether that has been smooth sailing or whether it's another false dawn, right? So I think once you get more clarity by the second half of this year, I think emerging markets would react one way or the other.
Han, thank you so much for your time. That is Han Tan, who is the Chief Market Analyst at Xfinity. We're going to take a quick break. When we come back, we'll have more news for you.